Okay, Wells Fargo, intrinsic valuation, perpetuity method, take one. All right, let's do this. First thing we need to do is to come up with the earnings per share. What I did was I went back and I went back to 2012 and I got earnings per share for the year for Wells Fargo, which turned out to be $3.36. I also got 2013, which was $3.89. The difference between the two on a percentage basis is 15.8% on an annual basis. Then I got the 2014 $4.10. Took the percentage change, I got 5.4%, which seemed a little low. And then what I also need to do is to be able to forecast what the 2015 growth rate is going to be, and then multiply that by the 2014 to be able to get the 2015. So what I did was I first took the average between the 5.4 and the 15.8 and came up with 10.6%. So that's kind of a benchmark rate for me. Then what I did was I looked at the quarterly earnings per share for third quarter 2014, fourth quarter 14, first quarter 15, second quarter 15, and third quarter 15. First thing I did was I took the percentage change between the third quarter and the second quarter, and I got 1.9%. So that's a quarterly return or a quarterly growth rate. Multiplied that by 4 quarters, which gave me an annualized growth rate for earnings per share using the most recent quarter of 7.6%, and I rounded that up to 8. I tried to do year over year from third quarter to third quarter, 15 to 14. I would have also done second to second, first to first, and fourth to fourth, doing year over year changes for the quarters to get some annualized run rates. I would have also, which I did do, is I did percentage changes between the first and the second, the fourth and the first, and the third and the fourth, and then multiplied those by 4 to get annualized rates. I also did the third quarter to first quarter, which is basically a 2-quarter or half a year percentage change, multiplied it by 2 to get it annualized, and then the last method that I did was I went back 3 quarters, did the percentage change, divided it by 3, and multiplied it by 4 to get it annualized. So I tried to manufacture or simulate some growth rates, and the other methodologies really didn't give you the growth rates that I thought earnings per share should be growing at or could be growing at going into the future. So I really focused in on the third quarter to second quarter percentage change times 4, 7.6%, rounding up to 8, so I got 8. And then I looked back here at the 10.6, and we figured that the growth rate going for the rest of, for 2015 would be someplace between 8 and 10%, and the research team came up with 8.5. So then I went back to 2014, got the annual earnings per share of $4.10, and multiplied it by 1.085 to get the 2015 number. The research team also felt that the growth in earnings per share would carry over into 2016, but would be less than 2015 and the average between 14 and 13, and they came up with an estimated growth rate for 2016 for earnings per share of 7.5%. So I took the 2015 earnings per share of $4.45 and multiplied it by 1.075 to get the $4.78, which will be the earnings per share for 2016 and really the benchmark earnings per share for valuations. So now that I have at least the 2016 earnings per share, I set up the valuation equation and I put the earnings per share in the numerator. Now what I need to do is to be able to calculate the discount rates. What we decided to do for discount rates was to use the capital asset pricing model, the expected return on the stock market using the S&P 500, and calculate the weighted average cost of capital. The first one that was easy to come up with was the expected return on the market. We went back and calculated total return for the S&P over the last 10 years, and it came out to be 7.65%. So we rounded that up to 8% and plugged that into our model as the first discount rate. The second one was the capital asset pricing model. We talked about it. The current 10-year treasury is yielding 2.3%. Based on my research, the highest that the 10-year treasury has gotten at this stage of the recovery and the growth phase of the business cycle going back 30, 40 years was 5%. Interest rates are at historical lows, so I don't believe that 5% is still a reality. So I took that down to 4%. So we looked at the current 10-year treasury yield of 2.3% or roughly 2%. My estimate was 4% potential high of the 10-year treasury. So we basically took a midpoint of 3% to use for a forward-looking risk-free rate, assuming that the Fed raises interest rates, higher inflation expectations, and an upward shift in the yield curve was our overall interest rate forecast. So now that we have the risk-free rate and we have the market expected return on the market, we can calculate the market risk premium, which is the return on the market minus the risk-free rate, which turns out to be 5%. So the next step is to come up with the beta. The calculated beta for Wells Fargo is less than 1%, or 1. We didn't think that Wells Fargo's beta was 2, that was too high, and we also thought that the beta would be too high, or at the high end of the probability would be 1.5. So if it's currently less than 1, or roughly 1, and we think the high point could be 1.5, what we decided to do is to take a midpoint of 1.25. That way it reflects more systematic risk. For Wells Fargo, we believe that the movement in the total return on the stock will move more than the market or the benchmark S&P 500, and that they do have debt on their balance sheet, and they are subjected to systematic risk. So a beta less than 1 didn't make sense, and a beta greater than 1.5 didn't make sense either. So we used a true beta of 1.25. Now that we have the beta, we can multiply the 1.25 by the market risk premium of 5%, which gives us a market price of risk of 6.25%. 6.25% plus the 3% gives us 9.25% as the expected return on equity, or the equity cost of capital, using the capital asset pricing model approach. So we just rounded that to 9%. So boom, now we have the CAPM approach. Now we need the weighted average cost of capital. Well, we have the return on equity, which is 9%, and then the team did the research and looked at the capital structure for Wells Fargo and felt that the target and optimal capital structure for Wells Fargo was 60% debt and 40% equity. So the 9% times 0.4 gave us 3.6%. Now we need to do the debt piece. We were trying to estimate what the cost of debt was, and we looked at other debt issues that had come out by the competitors. We looked at their ratings, their bond ratings. We looked at the current yields to maturity, the current duration on the debt, and forecasted interest rates too, because we felt that interest rates were going to go up. So based on the research, we came up with an estimated cost of debt of 6%. 6% times 0.6 gives us 3.6. The 3.6 plus the 3.6 for the equity gave us a weighted average cost of capital of 7.2%, or 7%. So now we have the 3 discount rate sensitivities. I did not adjust the cost of the debt by the tax rate, which would have been theoretically correct, but I wanted to be conservative, and it really doesn't do that much of of an adjustment. So now that we have the discount rates, we can divide them by the expected earnings per share for the different sensitivities. So the first thing I did was I divided the 2016 earnings per share by the weighted average cost of capital, which gave me a value of $68.29. I divided the expected earnings per share for 2016 divided by the expected return on the market of 8 and got $59.75. And then I divided the earnings per share estimate for 2016 by the 9% from the capital asset pricing model, and I got $53.11. Now that we got the perpetuity, we can do the Gordon growth.